And welcome to the Novuna Business Finance session on the new capital allowance rules. Now, I say the new there with slightly inverted commas because this is something that's been in place since April. So, whilst also we've referred to the session as full expense, I'm very much aware that many people will see tax and capital allowances as somewhat of a sort of the dark arts. So in a view to make sure that we're not making sort of decisions or looking at things in a vacuum, we've tried to really give a more sort of general flavour of the rules and overview of capital allowances. So that enables you guys to have context of the rules and then some just practical information about what it means for you and your clients. So just as a point to note, the session is really of a sort of general nature and doesn't touch upon any specific taxpayer circumstances. And therefore, we just ask you to treat the session as such. So we will, time permitting, as Katie says, open the floor for questions at the end. But if you do have a really specific question that you would, specific to your circumstances, please, we recommend you to just get professional advice as appropriate. I think the message I'm trying to say here is, please don't sue us. So the only other point I was going to make is just the real sort of the introduction is in respect of the rules that we're talking about today are the rules as of today's date. And the reason we say that and why that's particularly important in this instance is that we are part of a team at the moment. I'm getting an echo. Someone go on mute. Hello? Okay. So we are part of a team at the moment, working group, working with HM Treasury and HMRC at reviewing the full expensing rules, and progress is going well. I can't actually disclose what the changes that are being examined are, but the talks are going well, and all these rules could change in the near future. So, in terms of the context today, we'll just quickly introduce ourselves. Then we'll go on and look at what capital allowances are and just give you that very basic understanding. We'll then talk a little bit about what assets actually do qualify for capital allowances as plant and machinery. We'll then move into the sort of the nuances with the new rules and how they differ from the old rules. We will then go through some worked examples, just so you know what it means in terms of sort of pounds, shillings and pence. And then we're going to briefly cover some other allowances and then just open up the floor for some questions. In terms of that question and answer session, what we'll say is that unless we've got some really shy people on the line, we'll prioritise questions from the external participants because I'm conscious that any Novuna queries we can pick up back in the office. So, introductions. So, by way of introduction, my name is Vince. I'm the group head of tax here. Joined the business in May 2018. So, my day job is that I am ultimately responsible for all tax compliance and filing obligations and advisory across the business. So, we are a business with many businesses within a business, and as a consequence, we effectively encounter every single type of capital allowance you could, and plant and machinery and asset, etc., that you could ever imagine. So we're quite well versed in this because we have to do quite a lot of this as our day job. But as that is our day job, I would say presenting to a significant number of people is not the sort of thing we do all the time. So please be kind and bear with us. Prior to here, I worked at KPMG for 11 years in an indirect tax team, but I focused on the Japanese inbound sector and headed up the Japanese sector for VAT. So looking at Japanese businesses investing in the UK. And at that time, our previous legal entity, Hitachi Capital, was just one of my clients, which is how I ended up here. And then prior to KPMG, I worked at HMRC, where I was a VAT officer, essentially. So I have the whole set now, practice, industry, and HMRC. And I'll just hand over to my colleague, Conrad, who's going to be taking us through large parts of today.
Thanks, David. So my name is Conrad Guniewicz. I'm the Group Tax Manager, and I work with David, and I've been in the business since October 22. And before joining here, I was the UK Tax Manager for ISG, which is a large construction group with operations in Europe, Middle East, and Asia. And I worked across all taxes, and capital allowances was a big area of at stake for us, with various projects and various items we had to analyze. And before working in house, I worked for various corporate tax and employment tax departments with Deloitte and Safri's. So yes, without further ado, I'll just go straight to section 2, which is meant to give you an overview of capital allowances. It's going to be quite high level, so apologies if I'm going over things that some of you are already quite versed in. But the very first question to ask is, what are capital allowances? And for me, the easiest way to think about these is as the tax equivalent of depreciation. So when you purchase a capital item, and we'll get into the definition of capital later in the session, but when you purchase a capital item, you can't write it off fully in the year of purchase. Instead, you're going to be taking periodic deductions over the useful economic life of the asset. And this accounting depreciation is as a non-allowable cost for tax purposes, and you need to add it back to your profit before tax in your corporate tax computations. So capital allowances, therefore, are the tax equivalent mechanism for this, and they can be deducted when you are arriving at your profits chargeable to tax. And you can see on the pro forma here on the right-hand side, that's at a high level how the computation will operate with respect to capital allowances. You're adding back the depreciation and you're taking away the capital allowances.
I think the important thing, and an important thing to sort of flag here, is in respect of purchases and asset as well, because we're in a sphere here where we're looking at asset finance. So what we're really looking at in terms of when is our customer entitled to claim capital allowances, we're really looking at sort of HP arrangements here, hire purchase arrangements. So that's what I flag. Whilst there are sort of nuances and there'd be other circumstances where certain lease types will push for capital allowances to the customer, I think it's best to keep things simple, I think. And I think to say, we're looking at, when we've done a HP deal here, this is when we're looking at, can the customer claim capital allowances based on the asset type.
Thanks, David. And moving on to explaining why do we have such a mechanism, and specifically what can we actually claim capital allowances on. So essentially, capital allowances exist because HMRC doesn't particularly like the uncertainty associated with accounting depreciation. And the reason for this is, and the reason why HMRC don't allow a deduction for depreciation, is because depreciation policies vary across businesses. Some businesses write off assets over 5 years, others write it off over 4 years, within the generally accepted accounting standards. So there is a lot of room to maneuver and manipulate, your profits. So HMRC have introduced a way of guaranteeing a stable and fair system for writing off the cost of capital through capital allowances. And although there are many grey areas in the capital allowance legislation, it provides a consistent framework for businesses to utilize and refer to. And it also gives HMRC the fiscal mechanism through which they can incentivize certain business behaviors. For example, investing in green assets, as you would have seen in the last few years, and more generally, just encouraging greater levels of business investment at various stages of the economic cycle. So as we've come out of the pandemic, you would have seen the super deductions, just to accelerate some more business spend in the economy. And to answer the second part of this question, very broadly at this level because we'll go into greater detail of what qualifies in the later section. At a high level, capital allowances can be claimed on qualifying plant and machinery, and these typically include assets that you keep in your business for use in your business, as well as certain costs associated with installing such items. And plant and machinery can also include certain assets that are installed to your building, such as air conditioning units. These are known as integral features. And then there's also certain capital allowances you can claim on fixtures, such as fitted kitchens, but we'll go over more examples in section 3. Before we do that, I just wanted to go over the main types and rates of capital allowances. We'll cover full expensing and the enhanced first year allowances in detail in section 4, but just at a high level and starting with the standard and most basic level of capital allowances, you've got the writing down allowances, and these allow for an 18% deduction per annum on items in the main pool. So these are your standard assets. And then you've got a 6% deduction writing down allowance per year on your special rate pool items. And special rate pool refers to items that are long life assets, essentially that you keep in your business for a longer period. And these could include integral features and other things of a more permanent nature. So these writing down allowances reduce the balance of capital expenditure in each pool every year or every accounting period. And then when you dispose of assets on which you claim capital allowances, or the WDAs, the sale proceeds are then deducted from the balance in each pool. And if the proceeds exceed the tax written down value, which is the tax written down value is essentially the balance on each pool, you may get a balancing charge, which is treated as additional taxable profit for the business in the period of disposal. And this will be relevant later when we discuss the special disposal rules on the new 4-year allowances offer. But moving on to the annual investment allowance. This is one of the original full expensing allowances, which came into play in the late 2000s. It allows for 100% deduction in the year of purchasing the asset, up to an annual limit of £1 million per corporate group. So you would have to share this £1 million allowance or limit with other group companies. And if you exceed it, you would have to look to claim other types of capital allowances. And the AIA can be claimed on items in the main pool, so your standard assets, and it can also be claimed on items in your special rate pool, which makes it particularly attractive for businesses that invest a lot in these long life assets, or doing, fit outs or refurbishments of their offices, because a lot of those type of assets will be treated as special rate pool. And it's very attractive to businesses because it's more generous than the standard 6% that you get on a special rate pool, and the 50% that you'll get through the first year allowance, which I'll explain in a moment. There are certain categories of assets that are excluded from the AIA, and this includes most cars, and it also excludes second-hand assets.
I think on the AIA, this is the one where this is why we wanted to do the more sort of general session, because I think when we're looking at this and what's going to impact our clients and what they can do, the AIA is probably the one which is going to be the most useful tool with them. And I think it's also important to reiterate here that the AIA allows you to pick and choose which assets you take the AIA on. So if I give an example here, if that you had £1 million of expenditure on special rate items and then £500,000 on the main pool items, you wouldn't have to sort of apportion that 1 million across the piece. You could actually say, let's put all that 1 million of the special rate items in there, because I know I'm going to be able to then do full expensing, which Conrad's going to sort of touch on in a second. We can do the full expensing on the main rate items, which gets you basically the same effect. So the ability with the AIA to sort of pick and choose, I think is really quite useful, and I think is what's going to apply the most to our sort of customers.
Thanks, David. And another reason why we're highlighting the AIA here is because historically the limit was £200,000, and then it was increased to £1 million during the pandemic. And now in the spring budget, the Chancellor made the £1 million limit permanent. So that will facilitate businesses when planning investment decisions. So just touching on the full expensing first year allowances offer at a high level, because we've got a whole section dedicated to these. But what they are essentially are enhanced first year allowances, which replace the old super deductions or the temporary super deductions. And they operate identically to the previous super deductions. However, at a high level, they essentially offer an accelerated type of capital allowances of up to 100% of the cost of the capital expenditure in the year of purchase. And historically, first year allowances have been quite restrictive. They've only applied or mainly applied to specific categories of assets, such as energy saving and energy efficient types of capital expenditure. However, the government has broadened the scope of qualifying items, and now it includes, or since the super deduction, it includes all items that will normally fall into the main pool and the special rate pool. So the current offer allows for 100% deduction on all main pool items, so these are your standard assets, and then a 50% deductions on all new special rate pool items. And this is in place between the 1st of April 23 and the 31st of March 26. Now, as David has already alluded to, the AIA is actually more beneficial to claim if you've got special rate pool expenditure, and if the AIA is actually available to your business, because it might be used up by other group companies, or you might exceed the £1 million limit, in which case you have to consider the additional or other allowances when it comes to the extra expenditure. And the 50% FYA is still a great incentive if your additions exceed the limit, is what I was trying to get to. So on the right hand side, I've mentioned the old temporary super deductions. They operated in exactly the same way as the FYAs currently, except you had an additional 30% incentive, so 130% deduction on new main rate assets, but that came to an end as of 31st of March 23. The reason we included it here is because it might still be relevant to some of you if you've got accounting periods spanning that cut-off date, and if your corporate tax computation amendment window is still open. So this next section will cover qualifying plant and machinery in general and how HMRC would look to categorize what qualifies and what doesn't qualify. So the main takeaway from here is to recognize that there is no detailed legislative definition of what actually qualifies as plant and machinery for capital allowances purposes. Instead, there are some guiding principles and legal tests that have emerged from a body of case law over the years. And the main test comes from this case of Yarmouth in France, and it basically stated that the qualifying expenditure needs to relate to apparatus that you use in your business, as opposed to any items that are used in the setting in which the business is carried on. And it includes all items kept for permanent employment in the business. This is, of course, very broad and very subjective, and there are numerous legal cases over the years where the taxpayers try to argue with HMRC of what should and shouldn't qualify. And now, although I've said that there's no legal definition, there are certain legal legislative lists of exclusions. So in short, structures and buildings are specifically excluded from capital allowances. Instead, there is another type of relief called the structures and buildings allowance, which allows for a 3% write-down per annum. But I've included a slide on this at the end of the slide deck just for reference. And there are also certain exceptions to the exclusions which are written into legislation. And these include some of the items I've already referred to in the previous section, such as integral features, so certain assets that are installed within buildings, and other items that have specifically been identified through case law. So one of these items specifically listed in the Parliament Act is movable partition walls, such as the type you use to divide your conference and meeting rooms and offices. And then another interesting example came out of a case involving JD Wetherspoons, where Wetherspoons tried to argue that some of the decorative skirting wall panels that they installed in one of their pubs should be treated as plant on the basis that they create an ambience for their customers. And although Wetherspoons ultimately lost that case, it set a series of precedents for HMRC and for the taxpayers, which basically said that in order for an item to qualify for capital allowances, it cannot be seen as being fixed to the premises in which you operate your business.
It's a little bit of a strange bit of legislation, isn't it, really? I think it's just one of those, it's not actually defining what it is, but they're happy to say what it isn't. So I think it is tread carefully in respect of what's plant and machinery and just try and follow the principles.
Thanks, David. So the next couple of slides are just designed to give you a taste of the different categories of assets that you would typically see as being included in the main rate pool and the special rate pool. So this particular slide is on the main rate pool expenditure examples. The list here is not exhaustive, but you normally see these type of assets included in those pools. And what that means is you'd be able to claim the annual investment allowance on these items up to the full £1 million. If it's not available to you or you used it up, you can also claim the full 100% first year allowance if these assets are purchased new. And then you can also play around with the normal writing down allowances of 18%. So as David said previously, these allowances can be claimed in any order of priority, and it's up to the business to decide the most efficient use of available reliefs, and that is done through your corporate tax computation. But as you can see on the list on the right hand side, the normal main pool examples would include tools, IT equipment, goods vehicles, furniture, heavy machinery. One thing I haven't put on there is new electric vehicles, but also electric vehicle charging infrastructure and things of a similar nature. Then same applies here with the examples on the special rate pool. These, as I said before, relate to your long life assets, and if you incur expenditure on these type of assets, you can claim the annual investment allowance up to 100%, which is the most generous relief currently available with respect to these type of assets. And then that's obviously up to the £1 million limit. If that's not available to you, or if you've used it up in other group companies, then you can claim the 50% first year allowance. And then, having exhausted that, or if your planning strategies are different, you've also got the normal writing down allowance of 6% per annum, which will also apply to the balance of expenditure. Even if you claim the 50% first year allowance, you will continue to claim the 6% on a reducing balance going forward. And I will explain the mechanics in a future section in a future section of this presentation.
And just in terms of the special pool, that 6%, another sort of common one that's going to come up is going to be sort of high emission vehicles. High emission cars will fall into that. So that might be something that you see with your clients.
Thanks, David. But yeah, just looking at the list on the right hand side, as I said, special rate pool relates to long life assets. And in practical terms, this would normally relate to integral features of a building, such as electrical systems, hot and cold water systems, air conditioning, lifts, escalators, and as of recently, solar panels as well. Now, we've included the slide here on software because the last time David ran a session, we were specifically asked in the Q&A about what's the capital allowance treatment of software. So at a high level, HMRC accept that expenditure on software licenses and expenditure on developing software in-house where the software has a useful life of more than 2 years, then it can be treated as eligible for capital allowances. And this covers licenses, software developed in-house, as well as digital assets such as digital media, books, and other software intangibles that are owned by the business. One thing to call out here is if you want the capital allowance treatment on your software expenditure, the businesses are required to make an election in the corporate tax computations, because software is normally treated for accounting purposes as an intangible fixed asset. And with intangible fixed assets, the rules allow for a deduction for associated amortization. So if you're claiming the capital allowance treatment, you will no longer be able to claim amortization on software. You'll have to add it back and then claim capital allowances instead. So you'll have to decide what's more beneficial to your business. Moving on then to talk about the new first-year allowances offer in more detail. As David said at the beginning, we've put the new in inverted commas because this offer has actually been in place from the 1st of April 2023. It was introduced in the spring budget, and it replaced the old temporary super deductions, which were in place to accelerate business investment coming out of the pandemic. So they're essentially a less generous version of what we had for the last 3 years. And what they essentially exist to do is to accelerate the time it takes to get tax relief on qualifying expenditure up to the full cost of the item in the year of purchase. So if you're incurring expenditure on your main rate pool items, you can get 100% write-off in the year. And then if you've got special rate pool items, you can get up to 50% in year one. And then the remaining 50% is then added to your special rate pool, where you can continue to claim 6% writing down allowances in subsequent periods on a reducing balance basis. The good thing about these FYAs is that there's no expenditure limit, unlike the AIA. So you can invest as much as you want and you can claim as much as you want. And one thing to just consider is that these reliefs are limited to companies only. So your private customers will not be able to benefit from this relief. And one thing also to call out at this stage is that there are special rules associated with the disposals of items where you've claimed these enhanced first-year allowances. I'll go into more detail on those in a later slide. But essentially, if you dispose of items where you claim these FYAs, you'll get an immediate balancing charge, which is treated as a taxable profit in the year of disposal. Just a couple more slides that cover a little bit more detail around FYAs and capital allowances in general, and specifically who can claim them. So one of the things to consider, especially in the financial services sphere, is that capital allowances, and including these FYAs, they can only be claimed by the person incurring the capital expenditure. And what this means is that in order to benefit from the relief, your customers will need to be in a HP type arrangement where the contracts stipulate a transfer of ownership to the customer. And then another practical consideration is that the person named on the contract normally should be the person also paying for the asset.
And I think that's a little nuanced one, which I think we have to be quite careful with, because increasingly we see things like subsidies or all different types of arrangement whereby the customer may not necessarily pay all the full charges on an agreement and somebody else may pay those on their behalf. Now, our reading of the rules in those instances is that if there is a third party paying any part of that agreement, then you cannot claim the first year allowances and the full expensing. So it's just something to be careful of, I'd say, when you've got a sort of a subsidy or any other party paying part of the agreement, just to navigate that carefully.
Thank you, David. Just moving on to the special rules around disposals where you've claimed first year allowances. So as mentioned on the previous slide, Special rules apply when you dispose of assets which you've written off completely with the 100% FYA, or where you claim the 50% FYA as well. So in the first instance, if the asset's been fully written off and you dispose of it in the period in question, so between 1st of April 23 and 31st of March 26, you'll get an immediate balancing charge equal to 100% of the disposal proceeds. So that's different to the normal rules where you will just take that amount and take it away from the balance in your main pool. Instead, that will be treated as taxable profit in full in the year of disposal. And that will be subject to tax at 25%. And then if you've claimed 50% first year allowance on an asset and you've disposed of it, you will have a balancing charge equal to 50% of the disposal value. And then the remaining 50% will be taken away from the balance of your special rate pool. And that 50% of the disposal values will also be taxable at 25%. And just another key takeaway here and consideration when it comes to FYAs is that there are some deferred tax considerations when you're claiming these enhanced reliefs. And this is because the net book values will exceed the tax written down values of the assets. So what this means for businesses, if you claim the enhanced FYAs, you will create additional deferred tax liabilities for the company. So the total tax charge in the accounts might not change at all because the accelerated capital allowances are likely to decrease your current tax and create a corresponding increase in deferred tax. So obviously this assumes no changes in the corporate tax rate, but the main benefit of claiming these is from a cash flow perspective. You get immediate write-off on the cost of the asset, but from an accounting perspective, what you report might not actually change.
So if we look at the accounting impact, say last year when it was for super deduction, we had yes, you got the accelerated allowances with the super deduction and the 130% deduction, but that was at a point in time where we had a 19% tax rate. But for those periods there, knowing that we were going into the 25% tax rate, the deferred tax would have been measured there. So there was a mismatch historically, which was something where there could be differences in respect of the accounting treatment. Now that we're in a 25% tax rate, and on the assumption that for the period of the next 3 years that we've got your current tax and your deferred tax both at 25%, like you say, they should even out and net off against each other. So this really is a cash flow thing rather than an accounting impact.
Thanks, David. Just very briefly, just talking about exclusions from the enhanced first year allowances. You can't claim them on most cars, except for electric vehicles or new electric vehicles specifically. And you can't also claim it on second-hand assets. And this will be relevant for any sale and leaseback scenarios. So it's just something to keep in mind. The plant and machinery has to be brand new. And then more generally, expenditure on assets acquired for leasing will not qualify for these enhanced allowances. So unless, like I said before, unless the contract stipulate a transfer of ownership to the customer, the customers won't be in a position to benefit from these enhanced reliefs. There is an exception to this. I've just mentioned it there after the asterisk. Sometimes where you provide an asset together with an operator, it can be treated as qualifying, but it applies in very specific examples and something that we've seen in our business in previous years.
Yeah, I'm just going to go back to the second-hand piece because I think this is a little bit, just to give a practical example. So if you've had a customer who has purchased an asset from a supplier and then wants to sell it back to us, and then we do a HP back to them, the way that can get tackled caught by these rules as a second-hand asset is if there's any sort of gap in any of those transactions. So you've had the supply from the original supplier on the first, but then the actual sale to the financial services provider happens on, say, the 5th. So you've had the asset being used for 5 days in the business or whatever. So unless they're sort of back-to-back transactions, you've got a potential issue there. So again, it's just something to be mindful of, and making sure you don't inadvertently create something that's second-hand.
Thanks, David. I've included a slide here just as a cheat sheet more than anything. It's for reference purposes only. It kind of covers a lot of what I already talked about with respect to FYAs. The only thing I wanted to highlight here is that the new first-year allowance offer brought in specific categories of assets into the remit, specifically electric vehicles and electric vehicle charging equipment. Now, some of this would have qualified previously, but the guidance from HMRC perhaps wasn't as clear and bulletproof, so this was clarified through the new offer. Now, this here is just designed to give you an illustration of how these reliefs will operate mechanically. And this is a very basic example of how you'd claim it in your computations and what the impact is of the different types of capital allowances on your tax and your taxable profits. So the assumption here is that you're purchasing an asset worth £200,000. The asset is depreciated over 5 years on a straight line basis, and the company that we're hypothetically working with has a pre-tax profit of £1 million. So starting off with the AIA, mechanically the AIA works exactly the same as the 100% first year allowance. So you'll see the first two columns are identical. And what happens when you're claiming either of those is you add back the depreciation, which over a 5-year period is equal to £40,000. So you're adding that back to your pre-tax profit, and then you're deducting the full cost of the asset. So that's the 100% relief in year 1 to arrive at a taxable profit of £840,000, and tax payable at 25% is £210,000. And the thing to call out here is that depreciation adjustment of £40,000 will continue for another 4 years, and then you're not getting any more allowances going forward on that item. Now, with the 50% FYA, the difference here is that you're deducting 50% of the cost of the asset in year 1. So that's the £100,000 in the middle row there. And then the balance of the cost of the item is added to the special rate pool. So you'll continue to claim 6% writing down allowances on the remaining £100,000 on a reducing balance basis. And then the depreciation adjustment will also continue for another 4 years. Now, the last two columns just illustrate how the normal writing down allowances operate. So this will apply to any balance of expenditure on your main pool and then in your special rate pool. So with the main pool, you're claiming a much less generous relief of 18%. So on an investment of £200,000, you're looking to get £36,000 capital allowances. And that will continue every year until you've fully written off the value for tax purposes. And then the depreciation adjustment will also continue for 4 years. And I think I've included 2 slides here just for completeness, which cover some of the other capital allowances available. I've mentioned structures and buildings allowances. They're available on companies dealing with land and building and construction spend, and that provides a much less generous relief of 3%, and that reflects the permanent nature of that expenditure. And then I've also included a slide here just for reference on research and development allowances for any R&D heavy businesses. So yes, thank you for listening, and as mentioned at the start, we're not tax advisors, and the information we provided here in the session is for information purposes only. So you should should obtain your own tax advice before making any investment decisions.
Thanks, Conrad. So that was the scary bit. We'll move on to the really scary bit now, and open the floor to questions. What we'll do is we'll get the slides off the screen, and we'll show our faces on camera, and we'll open the floor to any questions.
Yeah.
Do we have any questions? Have we blown you all away?
Hi there, it's John Davis here from Business Finance Trust. I don't know if you can hear me.
Yep. Hi, John.
Hi there. Could you please define a little bit more second-hand? I mean, are you saying that if somebody bought a second-hand crane for 250,000, it's not going to qualify?
Correct. Yeah, it's not going to qualify for the first year. I think this is the thing. It's not going to qualify for full expensing. So that's okay. The accelerated version of the capital allowances. You still will be able to get the standard 18% write down allowances. It's just
into the general pool, yeah.
Yeah, if we just think about it, about what's the government trying to achieve with this, and they want to increase investment, and it's almost like on the second-hand assets that's already there. They want new money coming into the system, and people building things, etc. So that's why it works. It's working in that way.
Yeah, but you might be able to do something with the AIA, because although it doesn't cover second-hand cars, the AIA, it might cover some second-hand items, and that's obviously up to the 1 million.
I find it incredulous, especially when the vast majority of goods that we're looking at funding are made abroad anyway, so there is no investment.
Yeah, there's lots of nuances in this, because for example, when they brought out the super deduction, when Mr. Sunak at the time was the Chancellor, and he stood up in front of everybody, he said, "We're bringing in this super deduction to really help the construction industry," as an example. Well, the construction industry uses a lot of plant hire, so they hire a lot of their equipment. So they didn't actually, the people who they were trying to stimulate there basically then weren't naturally buying lots of construction machinery because they would hire it. So they didn't actually qualify for the super deduction. So a lot of these things, dare I say it, they have a slight logic to them, but they don't necessarily always think them through and what's actually happening. So that's the gist of what they're trying to achieve.
Okay.
We can maybe question the execution.
One other quick one, please, is that just to cover an eventuality of a demonstrator which is unused but new. Sorry, used but technically, but and it would have been registered but unused in its practical sense.
In that regard, I will hold my hands up and say I don't know off the top of my head. Okay. And it's something that what we did last year or a couple of years ago when we did the super deduction exercise was that we supplemented our slides when we circulated them with some of the questions that were asked. So we can potentially look at adding something on there, but I think I would work on the premise, and don't hold me to this because we will double check. I'd probably work on the premise that it is potentially there a second-hand item, but we'll double check. Don't hold us to that.
Okay. Thank you.
Just a better safe than sorry, I'd say in that instance. Any more?
I can see a question in the chat box, so I'll just read it out in case you can't see it. Is this available to all VAT registered business, or is this subject to limited companies only?
So the accelerated allowances or the FYAs, they're only available to companies. So even if you're a sole trader and VAT registered, you won't be able to benefit from those, but you still be able to benefit from the normal WDAs of 18% and 6%. That's available to everyone.
Thank you. Does anybody else have any questions? Oh, there's another one in the chat box. How long can you carry over tax allowances?
Okay, so I'm gonna just operationalize that. So when it comes to the balance on your main pool and special rate pool that you're claiming every year, you're claiming that until that expenditure is fully written off. So there's no time limit per se. You're just writing it off at 18 or 6% until it's fully written off. So in your corporate tax computations, you will have a detailed disclosure showing the balance in each pool, and that is just carried forward in perpetuity until it's written off, basically.
And in essence, you aren't ever writing it off until you effectively dispose of it to remove it from the pool. Because if you had an piece of expenditure which was say 100, and it was a 6%, it was a special rate pool item, you took that 100 in, you then take 6 from that in year 1. You then take 6% of the 94 that's left in year 2. You then take 6% of what's left in year 3, etc., until you then dispose of it. So it basically carries on in that pool until you make the disposal.
Yeah, unless you're dealing with short life assets, which we haven't touched on here, but there are elections available for smaller types of assets like IT equipment, where the useful life is 7 years per se. You can pull them separately, and then you're limited to take the relief within 7 years. And then once the 7 years is up, you transfer it to your main pool, special rate pool, usually main pool, in the 8th year. But that's a very specific example when it comes to short life assets. Otherwise, there is no time limit to you dispose of the asset.
And that is just an election. So it is something there that you can elect. It's quite broad what you're allowed to elect to put into a short life asset pool. So it stays there. But if you got to year 8 on a when the short life asset pool is designed for things at 7 years or less, like you say, it just moves into your main rate pool. So yeah, there's not really any issues or limits there.
Yeah, but just reiterating the time frame for claiming the enhanced first year allowances is until 31st of March 26. So it's not that you can't carry forward allowances, but the enhanced relief is only available until the end of that tax year currently.
Thank you, Alan.
Thank you.
Oh, you could have been brave, Alan. You had your microphone off. You could have.
I know.
Any more? Because otherwise we will. Well, you've done well. Yeah, everyone who's sharing their cameras still on is all still awake, which is a good thing. But no, what I would say here is, Conrad said, we're not tax advisors as like tax practitioners that you see as accountancy firms and whatnot. But if you have any issues or anything along those lines, you have your contacts at Novuna who you can speak to, and they in turn have us who they can speak to, and where we can give guidance. It's not something you can necessarily hang your hat on, but we can point you in the right direction, and we are here to help. So just bear that in mind. And then I think we've got no further questions, we'll close the call.
Thank you.
Thank you very much. Appreciate it. Thank you.
Cheers.
Cheers, everyone.
Thank you.
Thank you for
Cheers.
listening.
Bye.
Thanks,
Bye.
everyone.